Welcome back, Rent to Retirement investors. We are going to do an educational series on life insurance. This is something that a lot of people are very interested in and is an essential piece of creating an overall financial blueprint, both on the tax side, has different options for investing in real estate over time. But the main part is just trying to build a comprehensive business plan and financial blueprint to set ourselves up for success. We've talked about this in the past, about life insurance and how fundamental it is for protecting your family and the hard-earned money that we all work for. But there's many other aspects that a lot of people are not familiar with and are curious about on how life insurance can be built around a strong tax strategy, mitigate market fluctuations over time, and potentially, expand your real estate portfolio over time to borrow against, while at the same time protecting your financial future and your family. We are going to revisit with Chris Reid here, who is our partner for everything life insurance. Chris, thanks for coming back to give us more educational content and golden nuggets on the life insurance side. Maybe we can start by just talking about how life insurance fits into an overall financial blueprint and why everyone should consider some sort of life insurance plan.
That's a great intro, and really what it comes down to is overall financial plan will contain all different types of asset classes. Right. So I got my start doing life insurance in 2014, but I invest in real estate. I love real estate, right? I'm obsessive about it. I also am a money manager who manages tens of millions of dollars of people's market-based assets. So what tends to happen is people get very focused on only one part, right? So insurance guys only want you to buy a whole bunch of cash value life insurance. The stock market, stock jocks down at JP Morgan Chase, they're going to tell you about the next Bitcoin. And then real estate, which I love. I just have been an investor since I, bought a piece of stock with paper out money. The bottom line is all these different asset classes do different things. Life insurance specifically has two main benefits. Number one is the tax shelter. The people that I've been talking to, anybody who's watching this podcast has a brain for investing. They are going to do well, earn money, and work hard. There's no question that is the case. I have not talked to somebody who doesn't fall into that category. The amount of debt that this country owes is $33 trillion in unfunded obligations. And as anybody watching this podcast knows, interest payments are a real thing. So if you look at a chart of historical tax rates in this country, we are at almost bargain basement all-time lows. Nobody feels like they're paying small taxes, but the actual historical fact is that in the 1960s, every dollar you earned over a certain threshold was taxed at 90%. Every one of your real estate investors who's crushing it with you on the real estate side needs to understand that even if you look at the current political climate, what Washington and the legislature has proposed is essentially taxing all income, unearned, passive, capital gains as ordinary income. So you have to ask yourself, with $33 trillion of unfunded liabilities and income taxes as low as they've ever been, what is Congress going to do to jack up their tax receipts? There's really only one place they can go. They can stop spending. No, we're not kicking grandma out in Boca Raton. We're not stopping her Social Security payments and making her buy cat food. That's not happening. We're not going to stop giving, and it's not political. It's not left, right, or center. We're not going to stop. We're not going to kick sick people out of hospitals. So the only place Congress can go is by raising tax rates. So everybody who's listening, you're saving to a pre-tax 401k or an IRA, or even if you have a Roth, congratulations. Having a tax-free cash accumulation strategy is of the utmost importance to make sure that Uncle Sam doesn't come into your $2 million portfolio and tax half of it away in retirement.
What you're saying, just to summarize, because it's interesting when you look back at the tax brackets and where we've been, people generally look over the past, 10 years really, or past one or two administrations and say, and see and use that as a relative baseline to compare taxes. But really this country was taxing an extremely high amount for high income earners, to the point where, like you said, upwards of 90%. You can look this up on a graph and see, based on tax brackets, where those have been historically. And so people complain about, even just small bumps in taxes, but there's only one way to go is, over time, regardless of who's in office, we're going to see increases in taxes. And so while you're getting a possible some sort of tax advantage on a retirement account or something right now, the idea of that would be to have less taxes owed when you actually use that, when the government stipulates you can use that, and because they're really controlling that. But there's a very high likelihood that growth is going to be also taxed at a higher rate. over time. Am I hearing that correctly?
Essentially, yeah. I mean, so number one, what people don't understand is when you take a $100,000 distribution from your 401k, congratulations, you worked hard for 30 years. You get the $100,000 distribution from your pre-tax bucket. You also get one other document, and that's a 1099-R. So whatever your Social Security earned income or real estate investment income, whatever that looks like at the time you report your taxes in 2052, 30 years from now, you get that 1099-R, you hand that to your H&R Block guy, that tax accountant's going to add $100,000 to your taxable income for the year. So anybody who tells you that you're going to be in a lower tax bracket, congratulations. Do you want to make less money in retirement? No. And then B, find me somebody who thinks taxes are going down. If tax brackets stay the same, pre-tax, post-tax is almost a straight wash. If somebody wants to try and convince me that income tax rates are going down in the future, Google historical income tax rates and look at any chart and show me how much lower we can go, because you cannot. My thing is, if they double tax rates, okay, now you're in a 40% tax bracket, your $2 million 401k is worth 1 point, whatever.
A lot of the 401ks in retirement in general, but it's mainly theoretical, right? At retirement and financial independence and security long-term, it's planning for the future, but none of us are there yet. Most of us are not, at that age point where we're actually starting to see that and know how that actually works when you take distributions from your 401k. And right. Maybe that doesn't conform to what your initial plans were, but we really need to be educated on what this actually means and plan for it now. And that's exactly why we're having this discussion. Life insurance is important, again, because it protects the financial security of your family long-term. It can be used strategically for real estate investments and other things that you can have, basically a trajectory of guaranteed growth that's not subject to market changes. But what we're really talking about today is tax advantage, because taxes are going to be the highest expense all of us are going to pay in our lifetime. And actually, real estate at this point for us is much the same. It's all about, tax mitigation, because that is the highest expense. For us, cash flow is good. We're at the point in our income and on a personal level where we acquire real estate for tax strategies. Right. Cost segregation, 1031. This is life insurance is exactly on the same level. These are both age-old tax strategies that have built, into our country for many years and are underutilized and not fully understood. So let's tie this back around to, what does this actually mean? Let's actually go through either an example, or can you concrete, okay, it sounds good in theory, but what are we actually talking about and how life insurance can be the tax strategy?
Yeah, that's great. And it's actually, once you get over the tax code, it's funny you mentioned 1031s. That's one way you can take like appreciation from one piece of investment property, and 1031, a non-taxable exchange. In all the life insurance calculations that I do, every button that I click is a tax shelter button. There's a 1035 exchange you can do. So if you're listening to this and you have an old whole life policy, I promise you that thing's not doing what you think it's doing. But B, if you want to move that from one life insurance policy to another one, it's called a 1035. It's like, 4 tax codes away from a 1031, right? Because all we're doing is we're playing tax games. So yeah, I can show you an example. What happens is, the numbers are kind of wonky, but when I set up cash value life insurance for people, the question is, how much can you put away? How much do we want to, in your budget, and don't not do a 401k, for sure take the match, just do Roth, right? So start that Roth, don't not do a 401k. That's not at all what I'm saying. Take the match, put your contributions in Roth, but then after that, if you want something that is guaranteed never to lose value in the stock market, if the market tanks, you'll notice here, so on these contributions, this client wanted to do 19,000. We were kind of mirroring their Roth 401k. So he reduced his 401k contributions. He decided he could do $18,000 a year. And we kind of backed that in. This client actually had a need for $1 million worth of life insurance. So the amount of life insurance and the amount of money you can put in are related. They're governed by the tax code. So that's the math that I do with the software. And so what the IRS said was, for $1 million policy, the most he could possibly do is $18,024. So if he would put $18,025 in, he would violate the tax code. None of this would be tax free, and it would not do what we want to do, which is create a tax shelter. So
that's obviously what you're creating with people, right? When you're going through and building a plan, you're letting them know what their limits are and what exactly is achievable within the tax code.
Exactly. And it's actually kind of a weird conversation because we get on these Zoom calls and they say, well, how much does $1 million policy cost? Really, when we're playing tax shelter games, don't worry about me squeezing your budget and finding every dollar. I'm going to look at you after you're qualified. And once we find out what you're medically qualified with the insurance company for, at the action point, at the time it's time to make a decision, I'm not going to look at your family budget and impoverish you and say, you must put $50,000 a year into this policy. That is not how that conversation goes. It goes like this. Hey, Jim, you're approved for the cash value life insurance plan. How much can you afford on a monthly basis or an annual basis? And it's everyone from guys, just this particular client right here, he's just flipping like 4 houses through you guys a year, just making a killing. And he goes, you know what, man? I make about 20 grand a turn. He's living off his earned wages. And he goes, what I'm going to do, I'm just going to dedicate 1 house flip per year to this cash value plan. And I net about 20 grand a year off of 1 flip. So he goes, cool, sign me up for that $18,000 a year thing. So that's how we came up with that number, right? Other people, if they're on a fixed wage and they're making 80 grand a year, awesome. You're in the place where you're doing the right thing. You're taking action on your financial future. And they look at me square in the eye and they go, hey, Chris, I can do 500 a month. There's no hard line number that we have to get to. So in this case, this guy's just going to take 1 flip a year, plug it into this policy. And you can see out here at the time he's 51, he will have turned those contributions into, and this is on the low side. These are pretty conservative because of the regulatory environment. So I would say worst case scenario, he'll turn that $300,000 into $632,000. Now back to the taxation. If he wants to pull $100,000 from here now to buy another investment property, maybe a bigger deal, he can just take a tax-free loan himself his own money. And that's a loan that you do not pay back. It's a loan where the interest is paid out of the cash value, but then the insurance company actually pays you interest on the loan money. So if that interest payment is $5,000 because the loan is capped at 5%, but the stock market does 10%, well, they're going to take out 5,000, but they're going to give you 10. So now you're making arbitraged money on your loan money.
Can we review those points real quick? Because you just covered a lot of this kind of at a high level.
Sorry, I machine gun mouth it.
I love it. But just to break it down for all of us, they're putting in a policy, this individual's early 30s, they're putting in $18,000 a year based on what they're able to do, which with this person, it's just 1 house flip, but that's what they've dedicated. So there's a tax sheltering aspect of contributing to the plan, which grows tax-free over time. Right. If we're looking at fast forward, 15, 20 years down the line to where this is growing, they have this accumulated growth that has a baseline floor where they're going to achieve growth at a certain level, but also they could have potential for higher growth if the market outperforms the baseline. That's tax-free growth to the point where they could take out money in the future to then reinvest, but they're still earning interest on the loan that they've taken out from themselves at a tax-free loan, right? That they can go in and multiply the returns on that loan beyond just leaving it in the policy, potentially, if that's what they wanted to do. It's the ability to earn interest on the money as if it was still in the account, but then also take it out to then, double dip per se, and earn interest on it in other avenues, other investments as well.
Exactly. Yeah.
Did I miss anything in that, or?
No, and functionally, it's like having a Schwab account. You log into your insurance company website, you click on take a loan, you type in the number you want, and the insurance company is going to ACH it to your Chase bank account. And then you can go put a down payment on an investment property. That's all you ever feel. That's all this client will ever feel is that $100,000 coming to his Chase bank account. And then so long as the market outperforms the interest rate, he's going to arbitrage that loan. So that $100,000, he still gets paid interest on.
And then the tax-free part of it is the growth over time. Both taking the loan out, that's not considered income, even though it was accrued interest over time. Normally you take a loan out, it could be a distribution or something like this of a different type of, investment asset. But here you're taking the loan out, it's tax-free, but you've grown the policy over time, tax-free, and you also have the same type of insurance. You still have you're still qualifying for the life insurance policy in the case that you need that. It's not like you're deducting that.
Correct. Right. So if this exactly. So if this client now, I don't want to get down in the weeds, but people with whole life policies, that was built in the 70s. That's like owning a really sweet Ford Fiesta from the 1970s. I hate to get technical, and I do with people on these calls, and I won't here, I promise. But you really have to be careful. If you're putting any kind of, I don't care if you're putting $100 a month, but God forbid you're putting 50, 100 grand a year into one of these, which a lot of people do as a tax shelter. If you don't have the right technical type of life insurance, you are wasting. It's not good.
Well, most people don't know. You don't know what you don't know.
Right? Exactly. So that's why and it's not their fault. It's not their fault at all. They graduated from college. Their buddy graduated. He had his MBA. Northwest Mutual came in, and with a recruiting center, they make those old whole life companies make you make a list of 200 of your closest friends, and then you go hit them up, and they feel bad because you're just starting out, so they buy a policy. And I have nothing against that. It's the way it used to be done. It's just that today, all those Pintos have been replaced by Ferraris that are specifically built to loan you your own money without ever paying it back, whereas old whole life was not. So I'm not going to get any farther in it because we'll be here forever.
I want to make this point abundantly clear. There's a reason that I asked you, that we partnered with you, and that we, work with you, and that I've asked you to come on this podcast is simply because you understand the comprehensive approach, right? This isn't just setting up life insurance for someone without understanding the overall comprehensive strategy to their investment plan. Just like real estate serves its purpose, so does life insurance if you're doing it appropriately. But there's so many different options and so many different ways to sell it and structure it. How do you know it's really set up? Most people set up life insurance because they want life insurance to protect, in the unfortunate event that they need it. But you can do it a lot more strategically. And I guarantee the wealthy people in this country, the people also running this, they're all taking full advantage of it because they have the right people, the right network, and the right team members in their financial team to make sure that they're setting up their life insurance policy and all their investments appropriately based on their goals. Exactly.
It's really the difference between having a strip mall tax guy and like one of your rent to retirement tax guys helping you. I mean, the difference that can make on your overall financial plan is huge. And maybe you and I can do like a more kind of detailed, in-depth follow-up. People should tune in if they want to like actually see the technical ins and outs of these different policies. But I have example after example of policies that were not set up the correct way, and people are surprised and angry when they see what kind of money they've put into these things, that they're just not done the right way.
Is there anything else? And that's important. Like, even if you have a policy set up, like how you got to revisit when and how was that set up. Policies are dynamic. Financial situations, things are dynamic. You need to revisit this stuff. It's not just do it and forget about it. I mean, you can for a certain extent if you set it up appropriately, but you need to revisit these things. Just like with an investment property, most people think they want to own it for 30 years and just leave it. You can. Is that really the most strategic thing to do?
Right, you can.
Probably not.
Right.
So you need to, people want passive income. That doesn't mean you forget about portfolio management and money management. That's never a passive thing. Now, you can have the right advisors on your side, which is exactly what you need to do, and why we asked you to, explain this. But you need to revisit it. Is there anything else before we tie up that you wanted to go over from this example?
Not really. I mean, each of these is so individualized. Honestly, it's just that if this is the type of thing that you're interested in and we have that conversation. I mean, I was telling you before we started about the adult family home that I closed on last week. I know what those numbers are going to produce. I know what it does for my family and my quality of life, and I know where it fits in my overall portfolio. But I would not be here where I am today if I wouldn't have taken action 7 or 8 years ago by cashing money, and that was scary. I cashed $200,000 out of my primary residence. But it's that type of thing. Now I'm 42. I did that when I was 33 or 4. I wouldn't be where I am today if I wouldn't have. And it's not all roses and sunshine, but if we have this conversation, you just have to take action. And I've been doing this long enough. I know it doesn't matter what you're doing, just having the right setup and getting educated and taking action on it is the most important thing you can do, because nothing changes. You can have all the planning and information in the world, but if you don't change anything, it won't change.
I mean, you make a very valid point. I mean, most people, that's obviously what I think separates the successful from the unsuccessful, is the just simple fact of taking action. Even if you have, and I'll go back to real estate again, but even if you have an unsuccessful real estate experience, you have the experience that's going to allow you to be a more successful investor over time. So many people get stuck in analysis paralysis, or they're simply lazy and they just don't do anything. But you need to take action towards because no one's going to walk you through this and teach you to do this, through traditional education. This is something you need to be proactive about. And there's a lot of different people out there that will sell you real estate and that will sell you policies. But is it truly in the best interest, or do they understand your overall financial blueprint? Maybe they come off like they do, but look at who the people you talk to. I don't take advice from people that aren't in the position that I want to be in the future. Those are the people I surround myself with. But you have to take action. At the end of the day, if you don't, you're in the same position. Everyone needs life insurance to protect their family, but do you really want to use this as a strategy to, better your financial future? I think the unanimous answer will be yes. So, I mean, obviously, if someone's interested in exploring this more, they can set up a consultation with you to go through this. You're not here to just talk about life insurance and why it's important. Yes, you'll have those conversations, but obviously your time is very limited with all the professionals that you currently work with. So really, this is a matter of if someone's serious about taking the next steps and initiating a policy or reviewing a policy that they currently have and possibly needing to reposition that more strategically. Those are the type of people, I guess, that you'll open your time open to speak with. And
I will tell you, I love Rent to Retirement. So people who I talk to are phenomenal. They're great people. And I'm so thankful that we met the way we did. And then it's turned into this great relationship, because just being part of a team that helps people, I've just always helped people in my life. And so it's fun to do this type of thing for people who need it. So yeah, it's been awesome.
Yeah. Surrounding yourself with like-minded people, and it's all about your network. If you talk about the rich dad and Kiyosaki, he's got his advisors, you know what I mean? And he hits that home all the time. You got to surround yourself with the people that are operating at a high level, which most people are not. And they don't understand the full capability of how to strategically use things like this, real estate, life insurance, whatever the case is. So that's why we have you part of the team, Chris. So just to review, life insurance, fundamental for financial security, protecting your family, has the ability for baseline growth where you don't have fluctuations in the market. You have the ability to leverage against it, be your own bank, and reinvest in other asset classes to double dip and get multiple interest accruement. But fundamentally, the biggest probably take home is that this is tax-free growth and one of the most prominent tax shelters available in this country, and you need to be utilizing it. So go out, learn about it, educate yourself, talk to people, talk to Chris. If you're serious, get it set up and do it right. And if you have a plan already in place, revisit it from time to time. Make sure it's the most appropriate plan. So anyways, we'll include your information, Chris, in, it's on our website. Obviously, you're one of our partners. We appreciate everything you do. We'll put your contact information and a link to this video as well. And I know you look forward to educating more of our clients on how they can strategically use life insurance.
Yeah, it's been awesome.
All right. Thanks for your time.
All right. Thanks, Zach.